Hello, everyone, and welcome. Today, we're jumping right into a topic that's, well, fundamental for any business or tax professional in India: depreciation. We're going to unpack the key rules and calculations under the new framework of Section 33.
All right, let's just paint a picture. Your business has made a big move, a significant investment in new machinery for 10 lakhs. Now, you can't just write off that entire 10 lakh expense in one go. So how does the tax law help you recover that cost? Well, the answer is all about a powerful tool called depreciation.
So here's how we're going to break it all down. We'll kick things off with the basics of what depreciation even is. Then we'll dive deep into Section 33 itself, walk through the actual calculations, touch on some really important special cases, talk compliance, and then wrap it all up with the key takeaways. Sound good?
Okay, first things first. Let's tackle that opening question about the 10 lakh machine. To do that, we need to understand why depreciation even exists. It's basically the tax system's way of acknowledging that your assets wear out and lose value over time.
Think of it this way. It's a non-cash expense. No money is actually leaving your pocket each year, but the law lets you claim an expense anyway. This reduces your taxable income, and it reflects the fact that your assets are getting older. It's all about spreading the cost of that asset over its useful life.
Now, let's get into the law itself. Under the Tax Act, Section 33 is the main event. It's the provision that lays out all the rules of the game for how businesses can claim this super important deduction.
So the big question is, what can you actually claim depreciation on? Well, Section 33, subsection 1, is very specific. It covers your typical tangible assets, buildings, machinery, furniture. But it also includes intangible assets like patents and trademarks as long as they were acquired after April 1st, 1998. And check out that last point, it's a big one. Goodwill of a business? Nope, not eligible for depreciation. You've got to remember that.
Now, here's a concept you absolutely have to get your head around: the block of assets. Seriously, just think of it like a bucket. You take all the assets that are similar, like all your general machinery, and you throw them into one bucket. Why? Because they all get the same depreciation rate. This makes the math so much simpler because you're not tracking every single chair and table, just the block as a whole.
So, Section 33 actually gives us two main ways to do this. The first, and by far the most common, is the written down value method, or WDV. This is the one that uses that block of assets concept we just talked about. The other method is based on the actual cost, but that's a really special case, pretty much just for companies that generate or distribute power. So for today, we're focusing on the WDV method, because that's what's relevant for almost everyone.
All right, let's get into the nitty-gritty. How do you actually calculate this thing? Understanding how the WDV method works is absolutely key to getting your deduction right.
It's actually a pretty straightforward four-step process. First, you start with the opening value of your asset bucket at the beginning of the year. Step 2, you add the cost of any new assets you bought and add it to that bucket. Step 3, you subtract any money you got from selling an old asset from that same bucket. What you're left with at the end is the value you'll use to calculate your depreciation for the year. Simple as that.
And what percentage do you use? Well, the rates are all laid out for us in the income tax rules. As you can see, it depends on the type of asset. General machinery is at 15%, furniture is at 10%, but look at computers and software, a whopping 40%, which makes sense, right? That stuff gets outdated way faster.
Okay, but as you know, tax law is never just one simple rule. It's always the exceptions and the special conditions where things get interesting and where you need to pay close attention.
I want you to remember this number, 50%. This number is absolutely vital, especially when you buy assets halfway through the year. It's the key to what's known as the 180-day rule. So here's the deal. Section 33, subsection 4 is crystal clear. If you buy an asset and this is the key part, you put it to use for less than 180 days in that tax year, you can only claim half the normal depreciation, just 50% of the regular rate. So if the rate is normally 40%, you'd only get 20% in that first year.
And check this out. This is a direct quote from the official FAQs. The new act actually makes a small procedural change. You don't have to report the specific dates anymore, but you must now clearly separate your assets into two groups: those used for 180 days or more, and those used for less. What does that really mean for you? It means your fixed asset register has to be more detailed than ever.
And there are a couple of other conditions to keep in mind. What if you use an asset for both business and personal stuff? Well, you can only claim depreciation on the portion you use for business. And in cases like mergers, the law says you have to split the year's depreciation between the old company and the new one, based on how many days each of them used the assets.
All right, theory is great, but let's see how this all works in the real world. We'll run through a quick example and a compliance checklist to really bring it all together and help you avoid any common mistakes.
Let's imagine a company. We'll call them ABC Corp. We're going to look at their plant and machinery block, which, as we know, has that standard 15% depreciation rate.
Okay, let's walk through this carefully. ABC Corp starts the year with an opening WDV of 50 lakhs. They add a new machine for 10 lakhs and sell an old one for 5 lakhs. That leaves us with 55 lakhs that are eligible for the full 15% rate. But here's the twist. They also bought another new asset for 1 lakh, but it was used for less than 180 days, so we have to segregate it. We calculate the full 15% on the 55 lakhs, which is 8,25,000. For the 1 lakh asset, we apply half the rate, so 7.5%, which comes to 7,500. Add those two together, and the total depreciation they can claim is 8,32,500. See how the segregation works?
So to stay compliant, here's a quick checklist. A detailed fixed asset register is non-negotiable. You have to classify your assets into the correct blocks. You absolutely must track which assets fall under the 180-day rule. And of course, keep all your paperwork, invoices, sale documents, the works. And one last pro tip. If you sell an asset for a loss, make sure you write that loss off in your books. That's how you can claim what's called terminal depreciation under Section 3310.
And this really brings us to a crucial question for every single professional and business owner listening. Given this new requirement for explicit segregation, is your fixed asset register really up to the task? It's probably a good time to take a hard look at your internal processes.
Phew, we've covered a lot. So let's just take a moment and boil it all down to the absolute must-know points to make sure everything sticks.
All right, here's the bottom line. Section 33 is how you claim a deduction for the wear and tear on your business assets. For most of us, that means using the block of assets concept and the WDV method. That 180-day rule is a really big deal. Use an asset for less than that time, and your depreciation claim for that asset gets a 50% haircut for the year. The new law now requires you to explicitly separate these assets in your calculations. And the main theme through all of this? Meticulous, careful record keeping is absolutely essential.
And that wraps up our deep dive into depreciation under Section 33. I really hope this explainer has helped clarify the key rules and how they work in practice. Thank you so much for watching. If you found this useful, please do like, subscribe, and share it with your colleagues.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.